Well, good, depending on where you are in the world, good morning, like UN, who is joining us today, the CEO of Upside Avenue. Good morning to those in that part of the world, the US, the Americas. Good afternoon to those in the European time, South African time, and good evening, good night to those of our guests who are from Australia or Asia. And of course, good evening, I believe, Lee, to Lee Rush. I think many of you know Lee. She is our head of community at Wealth Migrate. And good evening, Lee. It's great to have you on board with us tonight.
Yeah, hi everybody. Thank you for joining us. We're very excited to introduce our new partner and their investment opportunity to you. So great.
So brilliant. Lee is going to be tracking any questions you might have and just feeding them back through to myself and to Ewan as we go through this webinar. So please, you will see on your GoToWebinar screen, there is a place where you can ask us questions and we will make sure that we get your answers, as well as there's a chat functionality. So if you'd like to chat amongst yourselves or even just drop comments in while we are going through the information, please feel free to do that. And of course, the big welcome this evening, well, this morning in terms of US time is to Ewan. As I've said, he is the CEO of Upside Avenue, which is our new sponsor on the Wealth Migrate platform. We listed the Upside Avenue product on the platform just over a week ago. If you come onto the Wealth Migrate homepage, let me share my screen with you quickly, and I will be able to show you that. Lee, can you confirm for me when you can see my screen?
Yep, we've got your screen. It's perfect.
Great, thank you. So if you come to the Wealth Migrate homepage, you'll see here I've logged in as Lyndon Booth, and here is our marketplace, and here is the Upside Avenue multifamily housing income REIT, which we are going to be found out about today and hearing you in. So if you click on it, all the investment information is on here, as with our standard listings, the summary of the financials, an overview, the market summary, the investment summary, and of course an introduction to our sponsor and the due diligence process. I'm not going to go through that, as you know. Our job here, both tonight but also in general, provide an opportunity for our sponsors to list deals, to talk to investors about the deal. So my goal tonight or this morning, depending on where you are, is to talk as little as possible and let you do all the talking as well as the questions that are coming from yourselves. So what I'm going to do is, with no further ado, I'm going to hand over to Ewan. Ewan, I'm going to just quickly make you the presenter. I know that you have a presentation you wanted to share with the investors. And maybe just as a start, a quick introduction from yourself as to who you are, maybe a bit about your history and your background, and then we can dive straight in.
Absolutely. Thank you, Lee. Thank you, Scott. Appreciate the time. Looking forward to sharing some information with y'all. So my name is Yen Young. I am the CEO of Casoro Capital. Casoro Capital is the sponsor or the owner of the brand Upside Avenue, which is our real estate investment trust, also known as the multi-housing income REIT. And what we do here is specifically to the multi-housing properties here in the U.S. And so, you know, the U.S. real estate market is doing very well. But not in all areas. And so what I wanted to do today is really spend some time to dig into why I believe the Upside Avenue brand and the REIT that we're doing and offering today makes a lot of sense and why it's more compelling than potentially just any real estate deal out there. All right, so I'll get started. So, you know, as there's a lot of talk in terms of economic changes and slowdowns, we've had a great run over the last several years, but what really is going to set everybody apart if there are changes and shifts in the marketplace? And I believe that it really comes down to our process, the way we do due diligence, and how we are experts and really truly focused on only the multifamily or multi-housing properties and what we do there. So I want to share a little bit of insight in terms of what we're doing and why that's unique. A little bit of history of the company. Casoro Capital started back in 2015. Casoro Capital is a partnership with another company called PPA, which has a 17-year track record in history. Over time, what we have decided to do is actually create additional brands that were more geared towards the investors, not only here in the US, but globally as well too. In terms of where we are today, there's a couple of key components that I like to talk about. Number one is really what area of focus. And the reason why is that if we know what markets we're targeting and why we're targeting those markets, it'll give you a better understanding of what makes this particular REIT unique. The other thing to talk about is really underwriting assumptions. How is it that through underwriting, or really another way to put it is our business plan, how do we put together a good business plan to be able to have a higher probability of success? And then we'll talk a little bit about expected returns, where I see the market and what's driving those expected returns and why we think we can accomplish those things. So the first area of conversation is really around the area of focus and what we look for in a property. And it's very important to understand that when we are out there looking for property, it's not just as simple as going out there and saying, oh, well, there's a multi-housing project there, we'll just go buy it and just do it. It doesn't work that way, because on every given day, we actually get bombarded with probably about 4 to 5 properties just in Texas alone that's available for purchase. But most of them don't actually fit, and we need to talk about, well, what is it that we're looking for specifically to allow us to be able to actually want to do that property or that project. And that's really what we call our arbitrage strategy. So what that means is really there's a couple of key areas that we look for to figure out, is there an advantage that we as a company can take relative to that property. The big areas that we look for is, number one is what is the economic value that we can derive from that property due to one of two things. One is really due to the fact that the property probably is underperforming in the market because either there has been no upgrades, the property has not been well kept, and so therefore the asset itself is depreciated, and there's an opportunity that if we actually renovate, fix it up, the value of that renovation actually exceeds the value of the capital that we put in. So that would be one arbitrage opportunity that we look for. The other arbitrage opportunity that we look for typically is in management of the asset itself. So a lot of times these properties require specialized teams, people that know what they're doing, to be able to understand the residents that live there, what the property needs, and how well does it run, and whether or not we can increase rents relative to market. And so when you see poor management or mistreated assets and properties, that typically creates what I call the arbitrage opportunity that we're looking for. The other thing that's very important to us is location. And you probably heard the old saying in real estate, the 3 most important things in real estate is location, location, location. I agree with location being very, very critical, because a lot of times people will say, well, I'll just take a poor asset and be able to just turn it around, and next thing you know, everything is fine. No, it doesn't work that way. It's very hard to change demographics. So demographics is a macroeconomic structure that it moves on its own, and it's very hard for one property or one asset to be able to change that. So therefore, what you have to look for really in location is several things that have to happen. Number one is it going through some changes that are part of the process of regentrification? If that is the case, then that gives us opportunity to increase the value of the asset by repositioning and reconstructing and remodeling it. The other thing to consider is also that on location is, where are the locations where you see a lot of job growth and a lot of demand for housing, but not enough supply? So you're looking for a mismatch between the demand and the supply, so that you can find areas where you know that the property you go into has a high likelihood of increasing occupancy if you fix the asset and you make the asset more inhabitable. So when we're looking for those things, we're doing a lot of analytical work around where, what is the population, what does the population growth look like, what are the intersections, is it a draw, what is it the access to major arteries, Those are all just, there's probably 150 things that we're looking at all the time relative to location and whether or not we believe that intersection and that location will actually attract people to the property and rent from there. And then the final thing that we focus on is really the type of properties that we're looking for. What we find is that if we are looking for certain types of returns, you can't get it from all property types. So it's important to look at things like the size of the property, how many units are on a property is important to us. And you can imagine why, because sometimes it takes just as much work to do a 50-unit property than it does to take a 400-unit property. Because when you have a larger property, you get more economies of scale. So we tend to do properties that are at least 200 units or more. And we're also looking for kind of what we call Class B or Class C type properties. And what we mean by that is that we're not looking for the high-end lifestyle resort type properties, because if there are any corrections in the economy, that's the first place that people leave. We are looking for more renting by necessity versus renting by lifestyle. And so we look at properties that allow us to play in that space. And the other thing we look for is the vintage. Like good wines, properties also have vintages. And there are just certain things that happen between each of the different decades in terms of how they were built, where the opportunities are, and how they age. That allows us to figure out where the arbitrage opportunity is relative to that. So we tend to look for properties that are somewhere between at least 1980s and above. We really like 1980s, 90s, and then sometimes we'll even look at properties that are a little bit newer, depending on where the location is and what other arbitrage opportunities we have. So those are the areas of focus that we combine together to give us our advantage in terms of our expertise, to allow us to get you the returns and feel comfortable that we can help you get your return on the investment.
Ewan, maybe I can jump in there. We have a question that's come through from Anne. Anne noticed that on the platform we have put this deal as a core plus in terms of our risk category assessment. You know, I know we've had some conversations with yourselves. Is it core plus? Is it value add? Where does it sit on that scale? And I think her comment here is noticing you speak about underperforming assets. You know, that there's an opportunity here that is not necessarily a completely secure core deal that's perfect lease, perfect everything, but there is that value add, slight risk to it. And I guess her question directly is, do you agree with the core plus categorization on the Wealth Migrate platform, or would you add it as a value add categorization?
That's a great question. You know, those are things that are very hard to split. I will tell you that our strategy tends to straddle right between the two. So most of the time people don't know if is this a core plus deal or is this a value add deal? And we say, well, it's got features a little bit of both. That's actually our niche. And I would say that when you look at it, most people try to categorize those things based on return and vintage, and it doesn't work exactly like that. It's not an exact science around that. What we tend to do is look for things that fit where they have the ability to become core plus, but really we have to do a little bit of value add work. So what we're trying to do there, and you'll find this pretty consistent through our strategy, is we're looking for things that can generate yield but still give us some upside. So when I say that, most people say, well, that's core plus. And I said, yeah, but we're gonna have to put some capital in it. And they're like, well, but that's more value add. And I said, yeah, you're right. So it really, if you categorize it, I think that when you look at it from the Reit's perspective, core plus is the right category to put it in. Even though that some of the work that we do might seem more like value add, the objective is really to get the asset over to a core plus type stabilization. So great question.
So if I can, yeah, you know, and is one of our very active investors who gives us a lot of insight a lot of the time. If I can jump in, so if I'm hearing you correctly, if it was an individual asset, just one deal, we might be more on the value add side, because there might be times where there's not a lot of dividend coming back to the investor up front because there's a lot of change, there's capital that has to go and it'll impact cash flow. But because you've spread this out over you know, as a REIT, you are able to spread it across multiple assets at any one time. It's highly likely that many of those assets would have gone through that stage and will be delivering regular returns. And so those assets will still be giving the investor regular returns, even if there are some of the newer assets where you're still putting in capital and not getting the returns. So as an individual asset, and it's probably right, quite a bit of value add, but as a collective, as a REIT, you're enabling it to be closer to the core plus with regular returns.
That's correct. So one of the advantages of being in a REIT is that you're in a diversified portfolio. So you're not taking on the risk of just one particular property or particular asset. So that if that asset or property doesn't perform, then all expectations are thrown out of whack. In this particular scenario, we already have several properties in there and we continue to add to the portfolio. And through that process, what happens is it starts mitigating the risk of too much variance or fluctuation. And that's one of the advantages of a REIT. Now, if you call it the downside, what it does is it also muffles the top side a little bit as well too, but you're taking on much less risk in order to get the returns that you're looking for. So there are kind of risk and return adjustments because of the fact that it's diversified and spread among multiple properties.
Great.
All right. Okay, I'll jump to section 2, and then Scott, feel free to interrupt me if there are any other questions that I can help answer. The second part of what we do is really around underwriting assumptions. So what are the factors that we consider that make us unique and able to do what we need to do? Number one is around rent growth. And there's a lot of statistics and analysis around rent growth. And we have to be able to say, okay, well, where are we, what is the asset able to do, and what is the positioning of that rent growth so that we can make good assumptions around that. The rent growth, which is your income, drives a lot of your return and your cash flow throughout the process. And so not hitting that rent growth number and understanding what that rent growth should look like can be very problematic. So we spend a lot of time analyzing that piece of it, and then we have to position ourselves to say, for us operating this particular property, where can we get this? Are we going to be the top of the market, the middle of the market, or are we going to lag behind? And what are the rationales and reasonings behind that? The other thing to consider is how much capital expenditure that we put in, right? So is it more of a core plus or is it more of a value add? And you'll find that what we try to do is that we try to maximize what our capital expenditure is. So literally we calculate what we believe the return is specifically just for the capital so that we know whether or not the amount of dollars we're putting in can justify the rent growth to get us to where we want to go. And then the final thing is really investment period. What happens with all assets is that as they start aging and changing, there might be additional dollars that need to come in. So what we do is we calculate where we think the investment should be let go because there may be more capital expenditures coming, and we pretty much maximize the value of your dollars that you put in. And all of those things are happening within every property of inside the REIT itself. So in every asset inside the REIT, we're looking at all of these aspects to be able to say, okay, here's the business model, and we're going to be able to make this work and be able to get the growth and the return that we're looking for, specifically for the REIT and for the investors themselves. All right. Third part is expected returns. So we're looking at the market today. The U.S. market has had a very good run, and we look at it and we say, where is it today and where do we project it out going forward? And going forward for us is typically the next 3 to 5 years. And when we're looking at the overall, our expected return for the REIT is going to be somewhere around 15%. So what we call mid-teens IRR, or internal rate of return. Now, a portion of that, because it's a blend and it kind of straddles that core plus and value add space, what happens is that a portion of that really is coming to you on a cash flow basis. So like today, we are already paying on any given quarter anywhere from 5-6% as high as 8-9% annualized. And so we're able to generate quite a bit of revenue already with the current portfolio, and then we expect that the market will appreciate. But we're tampering, we're dampening what we believe is the upside of that growth on the appreciation side, just to be conservative. We could potentially do better, but we could also potentially do worse. And it's very important to understand that our objective is to hit a 15% internal rate of return, so that we can maximize both cash flow, like a core plus, while still getting some appreciation like a value add, and that's where the blend comes into play. So when you look at the overall, that's kind of the goal and the target that we're trying to hit, and we believe that we can do that relative to the marketplace itself and where we're headed overall. So happy to entertain any questions around that, but that's really our expectations of the market today and what we believe we can do.
Yeah, we don't have any questions immediately on that, but it has something we've noted to have a chat to maybe after your presentation around. Already since we listed this opportunity, we have had investors asking us about that that annual process of the evaluation and how it actually works, and does it affect the share price? Do they get it returned to them? In what way? How does that work? So I'm not sure if you want to take that at the end of once you've completed this, and then we can dive into that.
No, we can tackle that now, because I'm getting ready to jump into some of the demographics to support kind of why multi-housing. But let's talk a little bit about the structure of the REIT. The structure of the REIT is you're buying shares, and what happens is that every property, because it's a portfolio of properties, all the properties are going to get, the REIT itself is going to do what they call a independent appraisal. And so what happens is all the properties get appraised in terms of valuation, and through that then translates into your share cost. Today, the REIT is at a $10 par value. And so at the end of the year, what we will do is we'll assess to see if there's been appreciation, depreciation, anything like that relative to the properties themselves. That then will translate into an increase or decrease of the share price of the par share. If there is an increase, which we anticipate that, you know, if the real estate appreciates, then the par value will go from $10 up to some other amount, $10.50, $11, whatever it might be. How do you capture that appreciation? What happens is that appreciation will continue until you sell your shares. And keep in mind that with the REITs, there is a 3-year time period where there is penalties for selling the shares itself. It's not huge, but there is a slight penalty for getting out in year 1 versus year 2 versus year 3. After year 3, there's no penalties to get out of the REIT itself. So that's when you can start potentially exchanging your shares to capture that appreciation, because the shares have gone from $10 to hopefully a higher par value.
Yes, so great. When we tried to explain this to some of the investors in the last week who were asking us our question, the bit we weren't so sure on is if I had to buy, so let's say, because bear in mind the Wealth Migrate structure is that we are coming into the Upside Avenue as a single investor. So each investor is not going to be able to choose when they want to come in or out. We are investing for a 5-year deal term. Just for our investors, we are likely to launch another product into Upside Avenue probably in 4 or 5 months time, where we will be taking a 3-year timeline, but this first one is the 5-year timeline. So the question that we were asked by the investors is, if someone else wants to buy then in a year's time, the assumption is that they would not buy a $10 share, then they would buy the share at the share price after the evaluation. Is that a correct assumption?
That is correct, yeah. So after the first year, if the par value changes, then when somebody comes in, they will be buying at a different par value, absolutely.
Great, so the question I couldn't answer them, and maybe you can, is the question then was, wouldn't it make sense to wait until the day before or 2 or 3 days before to make that investment? In this case, the answer we gave them, the answer we gave them was, in this case, because we're actually there for the long term, the 5 years doesn't really make that much difference in terms of when we're coming in. But I'd be interested to hear how you would answer the investor who asked us that question.
Yeah, so there is no kind of trying to cheat or time the components. I wish there was. There would be an arbitrage opportunity right there. What happens is that the pricing and the valuations get set, but what happens is as dollars come in and out, they are evaluated accordingly. So if you, let's say at the end of this year, we do the independent appraisal, and starting 2020, it's worth $11. Well, you can say, well, I'll just come in at that moment and then I'll just take the $11. But no, it actually is time weighted. So what happens is all the shares are factored in by time as well too. So I wish it was as simple as somebody trying to time it, but it doesn't quite work that way.
Yeah, that's great. So now at least we have a way to answer our investor who was trying to encourage us to try and jump in on that day before.
Yeah. All right, so I'm going to talk a little bit about some of the demographics that we're seeing and why we still feel very strong about the multi-housing sector and the multifamily sector. What you see here is a chart of in terms of the U.S. renter population between the age of 20 to 34. And you see that on the left side of the chart is by millions of how many there are, and then the years that we anticipate. So you see that there's still a big rise based on the U.S. Census Bureau, that there's still going to be a huge rise between 2019 all the way across the next 5 years of how many more renters are actually coming online. Now, this phenomenon is not magic. It just happens to be that the millennial coming through right now is as big of a population as the baby boom generation. And so because of that, they are now starting to come into the workforce and really maturing into the workforce. And what you're finding is that they actually don't like to buy houses. They actually like to rent because they like flexibility, choice to, in areas that they live in, the hassle and maintenance. And then truthfully, one of the biggest reasons why they don't buy houses and they prefer renting is really the fact that they have so much debt and consumer debt, mainly driven by student loans. And so they don't qualify, even though they have income by the time they start working, they don't qualify because they have, you know, tens of thousands, if not hundreds of thousands of dollars of student loans, which take them out of the market for being able to qualify for a mortgage to buy a house. So the combination of the population growth, the combination of their inability to actually buy has all generated this demand and lifestyle for renting. And you see that over the next few years, we're still projecting a huge amount of growth relative to the renter market itself. Now, the other thing we talk about is really around real estate and what real estate does in terms of from an investor perspective. And Theodore Roosevelt once said, every person who invests in well-selected real estate in a growing section of a prosperous community adopts the surest and safest method of becoming independent, for real estate is the basis of wealth. And that has always been true, that when you see that how people build wealth, a lot of it, most of the time, is tied to real estate as a hard asset. The old saying, they don't make any more of it, is true. The demand as population continues to grow and our lifestyles continue to grow, the need for housing continue to grow, and that density creates the demand for real estate, which is what creates that appreciation. So here's our contact. If you want to get more information aside from at the Wealth Migrate site, we have our site as well. And then if you have individual questions that we can help you with, you can also send us an email at hello@Upside Avenue, plus our phone number is there as well. The folks over at Wealth Migrate, both Lee and Scott, are also available to help answer any questions that you guys might have.
Great, thank you very much. I have a few questions that have come through. Can I fire them your way?
Yes, please.
Brilliant. So there's a question here that says, in your documentation, you talk quite a bit about the difference between a public and a private REIT, and the fact that a private REIT actually behaves more like real estate, where a public traded REIT behaves more like a stock, a normal equity stock. And is that and I guess reading into this question, I think we all understand, but maybe we don't. So maybe you could explain why publicly traded REITs often do have the swings that are more associated with emotional decisions around stock markets rather than the underlying asset of the real estate, and why that's an advantage that this is a private REIT.
Yeah, so that goes to the answer and question around liquidity. And so what happens is this, no different than in a private company versus a public company, the same scenario happens. When you're looking at a public company or a public REIT, what happens is that the valuation of that is being assessed literally on a daily, hourly basis. And so when that's happening, you're taking a lot of other factors in and making a lot of assumptions to create what they call the market price or the daily market price. And therefore, the ability to come in and out relative to that information creates that volatility, which makes it act exactly like a a stock versus a real estate offering. Because real estate, the value literally doesn't really change from one day to the next, right? If I've got an apartment complex that has 300 units, the value didn't change from today versus tomorrow. But yet, if it's publicly traded, because of that platform and that ability for liquidity to move, what happens is the valuation fluctuates, and those numbers become much more, I would say, assumed as opposed to reality. And so therefore, the ability to get in and out of it now has other factors that come into play, such as what's going on with the rest of the economy, or what's going on in terms of people's risk tolerance, and they say, well, let me get out of this and let me move into this. That creates that volatility that makes it act exactly like a stock. In a private REIT, what you have is much more realistic an appraisal evaluation, and that takes time, because real estate is not an asset that moves every day. It's something that over time, generates income and has appreciation. So in a private REIT, what happens is you don't have to worry about that, because you're not really assessing what you believe is the value of the asset until the end of the year, right? And then you have a much more realistic assessment of what that looks like and where that asset is. And that is really what creates that difference between a public and a private REIT. There are pros and cons to each of those. I think personally, being in a private REIT gives you a lot more stability and a lot more realistic income and earnings, as opposed to if you're in a public REIT, if the market turns on you, even if the value is still there, the public doesn't believe it is, and all of a sudden you've lost your appreciation and your value, which honestly to me makes no sense whatsoever, but that's how the public markets work, right? It's that volatility.
Yeah, I found that in your documentation, the comment I think that you listed there, that the publicly traded REITs are actually are traded more in a more volatile environment than normal stocks even.
That's right.
Which was a very interesting statistic for me. And I think there is a general sense in the world that we are going into an era of uncertainty and potentially high volatility over the next 2 to 3 years. And in a way, I guess that's why you are advocating that right now a privately traded REIT is a good place to be in.
Yeah, absolutely. It's funny because we always have to remind ourselves that when there are market corrections or economic corrections, that we are still human beings and we are very emotional, and we forget that sometimes, and we make the wrong investment decisions every single time when those emotions hit. And so at least with a private REIT and lower liquidity ability to get in and out, it gives you time to get over those emotional feelings, and you don't sell low and buy high, which is the opposite of what everyone should do. But inevitably no one does that, right? So at least with illiquid assets like the real estate, it allows you to like hunker down and be like, well, I can't do anything about it, and then let it do what it's supposed to do, which is you're buying low and selling high, right?
Absolutely. We've had another question here, follow up. It's I'm trying to find who said it here, but it doesn't say. It must have come in anonymous. It says, at the beginning, you mentioned that many multifamily opportunities come in almost every day. Does this mean the market is getting overcrowded?
No, the volume of trade is always happening. On any given day, there's always people wanting to sell and people wanting to buy. So that's not unusual. What we look for is not so much worrying about the volume, but finding kind of the diamond in the rough and looking for those opportunities. The more that comes on the market, it just takes more digging. So it is a disadvantage to us when too many properties come in. So we have to be now we have to dig harder and be quicker about how fast we can find the right thing, the right property. So that's the only disadvantage to us today. We actually like an active market because it gives us information about where things are trading and where the dollars are and what we can expect.
Do you have a particular region of the US that you're interested in?
We do. So obviously Texas is a state that we're very interested in, and we're very active in Texas and have been historically. And that's all driven by taxation and business friendliness of the state itself. So we have such a huge population growth, job growth, and economic growth compared to the rest of the country, that it's allowed us to be in this space a lot. The other space that we like is really what we call the Sun Belt area. So that kind of stretches, excluding California, from Nevada all the way across to Florida and the Carolinas. And that whole region is experiencing some very, very good growth.
Fantastic. I have another question that's just come through. It says, what's the current size of Upside? Real estate has got a very good run since 2008, 2009. And how resilient would Upside be to a large market correction in the coming years?
All right, we'll tackle each one of those. I think there are several questions there. So the first one was just the size of Upside Avenue. Currently, there are 4 properties inside of Upside Avenue. And the total size of it is about $4 or $5 million so far into those properties. What was the second part of the question?
How resilient would Upside be to a large market correction in the coming years?
Okay, so on market correction, if you look at the properties that are in there now, they are very much workforce housing. So we feel like if there is a correction, that's actually one of the best places to be. Most people do not, they have to have a place to live, and so that's one of the last things that they give up if they have to give up anything. So the types of properties that we're in are not types of properties where they're living what we call a resort or lifestyle. It's renting by necessity, and that's very critical. So we hope that strategy really holds up very well in a correction or recession.
Great. That last question was from Manu. I figured out how to see who the asker was. Sorry, it was hiding. So thanks, Manu, for your question. Appreciate it. We have another question here. In your documentation, you refer to multifamily, senior living, and student housing. Yeah. Do you invest equally across the 3? Do you think any one of them has more potential over the next few years than the other?
Yeah, so all 3, as you can tell, are renters by necessity as well, right? So all 3 of those, students have to rent when they're in school. Multifamily is we're already comfortable with, and then senior housing and senior living is actually the newest category where that is renting by necessity now, where they can't live in a single family home and they really need to be in a community. So all of those are by necessity, and so therefore we really like all those categories. We are not a believer in terms of the strategy of making it all equal, because remember with real estate, it is really property by property, and so we don't favor it to the point where it's 30%, 33% here, 33% there, and 33% over in the other category. Each time the deals and the opportunities come up, we evaluate them, and if we're overweighted in one category or another, we don't really we're agnostic to that. So that was a good question. But we do look for opportunities in all of those sectors.
Great, thank you. Manu has a follow-up question. He says, what is your target size in terms of how big would you like the REIT to get?
On the size of the REIT in general, what we're looking for is probably somewhere in the neighborhood of about a $50 to $100 million total equity out there. So this REIT just came online for us back in November, so it's still very, very new. It's less than half a year old at this point, or right around half a year old right now. So we'd like to grow it out to where we can probably put in well over 15 to 20 properties in it, and be able to have the diversification that we're looking for.
Great, thank you very much, and Manu, thank you for your follow-up on that one as well. Let me just see. I think that's all the questions we've got at the moment. So what I'd like to do is just for the investors online, if you have a look, I'm just going to share my screen. I think it is still sharing. Lee, can you confirm? Is that correct?
Yeah, I can see it.
Yeah, great. So for those investors online, if you come and have a look on our platform, there are some documents here that are available. Maybe you could just explain what these 3 documents are. I'll take the last one because that's a Wealth Migrate document. Sure. But just what they can actually get here online and see here.
Yeah. So the first document that you see there is called the Upside Avenue brochure, and this is our our more generic and general brochure about what the REIT is and what it does and how it performs. The fact sheet is the next document, which is more of a synopsis of some of the key facts and key questions that you might have. And then the final one is the deal structure memorandum, which is the actual filing and the structure of the REIT itself with the SEC, because we are a SEC product. So it is a regulated product. And so the memorandum gives you all the information and details there. And that is by far the biggest the biggest document that we have there for you.
All right, great, thank you. In terms of the deal structure memorandum, for all our investors, this is a single page. It explains the process Wealth Migrate goes through to take investors from all around the world. You know, most of our deals have 100 or so investors that we aggregate into a single structure, and we then put those investors into a single deal. So for us to be able to do that, we create a special purpose vehicle that aggregates all those 100 investors, and then from that special purpose vehicle, we invest as a single investor into each opportunity in this side, Upside Avenue. And that deal structure memorandum just explains to you as the investor the overall process here. I have
sorry, my apologies. That's the deal structure memorandum. I was thinking of my offering circular, which is probably document number 4.
Sure, not a problem at all. There's another question that's come through from one of our investors, and once again, this is probably a Wealth Migrate question. It says, we notice in the documentation that the minimum investment is $2,000, yet on the platform, the minimum investment is $10,000. Why is there a difference? So that again is a great question. As I've just explained, Wealth Migrate has to aggregate investors from around the world into a single structure. In order for us to get to a point where it makes financial sense for us to be able to pay for the structuring that we do for ourselves and on behalf of the investors, the minimum investment size that we need as Wealth Migrate from investors around the world is $500,000. That's the kind of point where it then makes sense for us to create all the structures that we do on behalf of investors. At the moment, for us to routinely be hitting that minimum, we have a minimum investment on the platform at $10,000. So that is really the platform's minimum for you to be able to join our structure that will then invest into UN's deal. If you were a USA citizen and not using the Wealth Migrate platform and investing straight, then that $2,000 is what applies if you're investing directly as a USA citizen. So that's just why there is a discrepancy between the two. Let me just check. UN, there's a question here around your investment committee and who actually makes the decisions at each point when you're deciding to, on behalf of the REIT, invest in a property or not?
Yeah, so we have a team, as you can imagine. If you look at the brochure, some of those folks are listed on the team. We have a CIO, Todd Marney. He makes a lot of the acquisitions and investment decisions that he brings to the investment committee. The investment committee is made up of myself. We have our property management president. We have our construction president, as well as our founder. So it's actually an aggregation of 5 of us that come together to make that investment decision. And our structure, just so you know, is it has to be unanimous, meaning that all 5 people have to say yes to the deal before we actually place the REIT dollars in. If somebody says no, then we actually will pass on the deal for the REIT.
I'm assuming you get a lot of no's.
We do. So the CIO, Todd, has learned a lot about what we're looking for. So he screens over probably a couple of 100 deals a year to only get us down to a few, right? So yes, that is quite a process all by itself.
Great. I think that's all the questions I've got from my side. Lee, do you have any questions that have come through maybe in different channels from your side?
Don't have any others that have not been covered already.
Well, that's great news. In that case, we are done. And Ewan, I don't know if you've got any final comments before we close and thank our investors for joining us today.
No, I just want to say thank you for the time and appreciate you letting me talk about something that I'm very passionate about. So I appreciate it.
Absolutely, you're most welcome. Thank you very much for joining us. To all our investors, please, if you have any further questions, let us know. We will make sure that if we can't answer them on behalf of Wealth Migrate, we will connect you directly and send those questions through to Ewan and his team and make sure we get you your questions as quick as possible. This deal is live on the platform. So we believe it's a very exciting deal. We are very excited to have Ewan and Upside Avenue as a new sponsor and a new deal on the platform, and really excited to get this deal moving. Not only once, we will keep rotating this deal every time we hit a minimum amount. We will invest that immediately and then reopen it up again for the next round. So we're very excited. This is a long-term relationship. And Ewan, thank you very much for your time today. Lee, to you as well, thanks for joining us. And thanks to all the investors. We hope you have a great day going forward.
Thank you. Bye-bye.
Thanks, guys.